Pleased to introduce our guest speaker today, Professor Sebastien Betermier, for today's National Pension Hub Insight Series, the NPH Insight Series. So Sebastien is a professor at finance at the Desault Faculty of Management at McGill University. He teaches investment management, applied investment, pension investing for both undergraduate and graduate levels. He's also been recognized repeatedly through nominations for teaching and excellence and coaching the winning team for Premier's International Risk Management Challenge through the years 2016, 2017, and 2019. And Sebastien, you'll be interested to know one of the judges for the Premier Challenge is actually in the audience today. Professor Betermier holds a PhD in finance from the Haas School of Business from the University of California, Berkeley. So all large Canadian pension funds invest heavily in real assets, including real estate, infrastructure, and land. Sebastien is going to share with us his latest research done by him and his colleagues, which show how these investments are driving green urban development in major Canadian city centres. Over to you, Sebastien.
Thank you, Bruce. Good afternoon, everyone. It's a pleasure to be here and share with you our latest findings. This is a paper that is joint with Yuedan Liu from PSP Investments and 3 researchers from the CEM benchmarking team, Alex Beef, Mike Van Bracht, and Quentin Spanner. It's a study funded by the Pension Hub as part of a broader program on the Canadian pension fund model. The first paper was published in the Journal of Portfolio Management in the April edition of this year. I had presented it back in September in the Insight series. We had painted a quantitative portrait of the Canadian pension fund model, looking at the performance of the Canadian model relative to global peers in terms of portfolio efficiency and liability hedging, showing that actually the Canadian funds did quite well. And then looking at the mechanics of this model, identifying a 3-pillar business model that consisted not only of managing assets in-house, which we know, to reduce costs, but also redeploying the resources from the cost savings internally to investment teams for each asset class, and also redeploying capital towards strategic asset classes like real estate. And what we are doing in this paper is it's building on that first study. Now we're taking the analysis down to the asset level, and we study how the large Canadian pension funds create value and manage risks in the private real estate market. You might ask, why real estate? This is first a strategic asset class in which Canadian funds are highly involved. If you think of the large Canadian pension funds, they invest about 14% of their AUM in real estate. This is big compared to peers. Global peers of the same size invest about 8.5% of their AUM in real estate, slightly more than half. It's a strategic asset class in which the Canadian funds are directly involved. Here, the difference is striking. If you're looking at the large Canadian pension funds, which, by the way, I'm looking at a 50 billion AUM and above here, invest about 81% of their real estate portfolio directly, whereas the global peers of the same size invest in 16% of their real estate portfolio directly. We see it in the news. There is a constant involvement of those pension funds in real estate. This is the Deloitte Tower in Montreal by OTPP. This is the 745 Thurlow in Vancouver by BCI. This is the RBC Water Park Place in Toronto by OMERS. This is the Texas Tower in Houston by CDPQ. These are just a few examples where the Canadian pension funds are very involved. And what's particularly interesting, and this is where it motivates a lot of the study, what we do here is part of their involvement is very much involved in green urban development. And what we mean by that is the retrofitting of existing buildings and the development of new buildings to meet LEED standards. And in particular, all these buildings here have received the LEED Platinum certification under the pension fund ownership. This is the highest level of LEED certification. So that leads us to ask 2 questions. The first one is, well, okay, what is the scope of the green urban development strategy by the Canadian pension funds? We'll find that it's quite wide. And second, does it generate financial value, right? And this goes back to a big question that asset managers are asking nowadays with the global push to ESG investing, is does investing in green assets come at a cost in the form of lower returns in the long run? And what we will show in the context of this strategy is that actually it does provide a win-win that not only contributes to sustainable development of the major city centers, but on top of that does generate financial value net of cost. So the analysis has three parts. The first part is an international comparative analysis. We focus on large Canadian and non-Canadian pension funds. Again, we have a USD of 50 billion as a cutoff here. When you're looking at the Canadian funds, they manage about 6% of the global pension assets. We go to Preqin, look at data on real estate deals. We collect all the direct real estate deals from 2010 to 2018 that directly involve a pension fund. It's about 4% of all the deals in Preqin. The average deal size is about 100 million USD. And the first analysis is very simple. Can we compare how active the Canadian funds have been in this market relative to their peers? Okay, so simple summary statistics. We're comparing Canadian funds, rest of the world funds. We're looking at the total size. This is for the buy deals here. What we're finding is within the Preqin database, the Canadian funds have about 33 billion of deals made versus 22 billion combined for all the non-Canadian pension funds. So what's interesting here is the Canadian funds manage 6% of global pension assets, but they are responsible for 60% of the total value of the direct real estate deals involving a pension funds. So they very much punch 10 times above their weight when it comes to direct real estate. And that 10-to-1 ratio is a statistic that we repeatedly find throughout the analysis as we look at different data sets. We see the same thing on the sell deals. Interestingly, when we're looking at the geographic mix of these deals, the Canadian funds are much more geographically diversified than their peers. So Preqin only shows us a small subset of all the deals out there, but we find that Canadian funds appear in about 10 foreign countries, whereas for an average non-Canadian country, we only see deals by those funds in about 2 countries on average. So there's a significant difference, which again is something that we find elsewhere in other data sets. And lastly, when we compare the geographic mix, what we find is that the Canadian funds have a different strategy than some of their peers. In particular, they invest a lot more in mixed use properties. And that's a point that I will come back later on to, because we associate it as with a risk mitigation type of strategy. Now, the LEED certification is an interesting certification to look at because it does pick up a form of value add strategy. If you go on the LEED website, it stares at you, why LEED? Next to the environmental sustainability, the website highlights prominently the economic benefits of going in LEED, ranging from instant recognition for the building, faster lease-up rates, higher resale value, healthier indoor space, lower use of energy, water, and other resources, brand enhancement. There is academic research showing that LEED is a profitable investment for developers. And so what we will do is merge the LEED database with the Preqin database. And for each deal that we have in Preqin, we will classify the deal as either basic, premium, or LEED value added. Basic means it is not LEED certified. It hasn't been. It doesn't show up in the LEED dataset. Premium means that the pension funds have purchased a building that is LEED certified but haven't done any upgrade to it. LEED value added, which is the interesting category, means that the pension funds have done some form of LEED upgrade to the building under their ownership. Okay, so we'll classify all the deals. And then again, we'll look at summary statistics again, comparing Canadian funds to the global peers. And what we will find is that the Canadian funds are much more active in initiating and completing LEED projects than their peers. So if we look at all the properties in the Preqin datasets, we find that for Canadian funds, about 27% of their Preqin portfolio has been in the form of a LEED value added. Whereas for the rest of the world fund, it's about 14%. So the Canadian funds are twice as active as their peers in LEED value-added strategies. Now, if we focus on the US office properties, the LEED is mostly pronounced in North America. There's a lot of deals in Preqin that are based in the US. So if we focus on that particular subset where the LEED certification is more common, then we see that the gap is even greater. For the Canadian funds, the LEED VA is about 48% of their portfolio of office properties. For the non-Canadian funds, it's about 20%. So we see a big difference in the involvement of Canadian funds in green urban developments relative to their peers. The next question that we have, and this is the part 2 of the analysis, is how big is this green urban development strategy in absolute terms? Does it make a difference? So what we'll do is focus on large Canadian cities where the funds are the most active. We'll manually collect hundreds of real estate transactions from annual reports and news releases. The Preqin dataset doesn't have enough deals to do this analysis correctly. So we'll gather this additional information from the reports, from the news releases. We'll look at the 9 largest Canadian funds. And we'll construct 3D maps of these transactions. So we want to see, once we take all these deals together, how big do they represent? Do we observe any systemic patterns in the large cities? So we collect from the city's websites maps, 3D maps on land parcels and buildings for Toronto, Montreal, and Vancouver. We'll combine that information with the LEED status, and we'll be able to map the Canadian activity in those cities. This is what Toronto looks like. This is a 3D map of Toronto's financial district. The financial district is in red. The colored buildings are all the buildings in blue and green that are owned or have been owned directly by the pension funds. The green ones are the LEED value-added strategies. What you can clearly see is that virtually all of the buildings in the financial district belong to the pension funds and have been greened by these funds. You also see it in the South Core district in Toronto. This is delimited by the orange box. You find that, again, the bulk of the buildings have been developed and greened by the pension funds. And there's a lot of greenfield investments that have been taking place in this neighborhood. It's a neighborhood that is adjacent to the financial district, that is close to the train station, and that have received a lot of development over the last 10 years. So I look at this map, I find that it's impressive. The map shows clearly the scope of the green urban development strategy by the Canadian pension funds. Toronto, as Canadian largest city and the home of 5 to the 9 headquarters of these funds, is very impacted by the activity of the funds. The same we find for Montreal. Again, the financial district is in red. A lot of the buildings have been owned and greened by the funds. In orange, we have the Quartier des Gares. Similar to the South Core, the Quartier des Gares is a novel neighborhood that has been developed recently. The map is old. The latest map that we can get from Montreal is 2016. So a lot of those buildings we don't fully clearly see yet, but those towers have been built since. And similarly for Vancouver, again, the financial district has been highly developed by these funds. The map for Vancouver dates back to 2010. So again, there's a number of buildings that we don't see that only emphasize the recent activity of these funds. So overall, if I were to summarize the scope of the green urban development, it's clearly wide. It's systematically applied across large urban centers. It's concentrated very much around the financial district and the adjacent neighborhoods in development. It frequently involves full-scale greenfield projects where the buildings are built from the ground up, as opposed to a pure retrofitting. Those buildings account actually for a disproportionate share of the LEED Platinum, which is the highest level of LEED's certification. If we look in Toronto, there's about 26 Platinum buildings. Out of those 26 buildings, 17 have received the platinum certification under the pension fund ownership. And it frequently involves an operating subsidiary. Thinking of Ivanhoe Cambridge for CDPQ, Cadillac Fairview for OTPP, Oxford for OMERS, and others. Oftentimes, the form of this development takes place directly through the subsidiary, which is wholly owned. The third question that we have is, does the strategy work? Can we do a performance evaluation? Now for that, we're going to use data from Sun Benchmarking. They have an exceptional database that collects information on funds around the world, on the asset allocation, on the percentage of real estate assets that are managed directly versus indirectly, on the annual real estate portfolio return, net of fees. We use for this analysis 241 funds from 8 countries from 2005 to 2019. And our objective is to construct measures of net value added relative to the benchmark net of fees. Now, the problem, and for all those of you who have been working in private assets, performance evaluation in private assets is challenging because it raises the question, well, what's the proper benchmark? And in fact, if you look at the reported benchmark in the SEM database, they vary a lot across the different funds. Several of the benchmarks are using a property index, such as, let's say, the NPI, a peer-based index. Some of them at a premium, some have a lag, some have a customized blend of different geographies. Some benchmarks are inflation-linked. Some benchmarks are based on REITs or stock market indices. Some other benchmarks are absolute, have a country premium, or have a specific customized benchmark to the fund. When you have such a large heterogeneity in the benchmark, it makes it difficult to compare the net value added across funds. It leaves the NVA, the net value added, open to interpretation. So we have a solution. We employ a common benchmarking methodology. We're going to recreate a benchmark for every fund. Okay, so for every fund, we're going to create a benchmark from a market-based indices. So we'll look at REITs. We'll have for every fund a global REIT, a local REIT, and a local corporate bond index that we need in order to adjust between differences in leverage between the REITs and the fund itself. We'll construct the return of the benchmark as an average of the corporate bond index, where B is the share of the benchmark portfolio invested in the bonds, and a diversified REIT index, which has some local REITs and some global REITs, and the parameter G is the share of the REIT portfolio that is invested abroad. We'll then smooth the benchmark in order to mimic the appraisals methodology that funds use. So we're going to have a smooth parameter S. We're going to lag the benchmark again to mimic what funds do in the reporting. So we'll have a lag parameter L in trading days. And then we're going to choose the parameters B, G, S, and L that ultimately maximize the correlation between the benchmark and the reported return. So we do not observe these parameters per se, but we can have multiple combinations of these parameters, and we can find what combination ultimately generates a benchmark that has as close a correlation to the fund as possible. So in a way, it's a conservative approach where we attribute as much as we can to the benchmark, and whatever is left, we'll look at that as the active component of the fund's return. On top of that, we'll set the parameter D, the bond weight, such that the fund has a beta of 1 with respect to this benchmark. The result of doing this is that ultimately we'll be able to calculate the net value added, the NVA, for fund I at time t as the difference between the fund return and the benchmark return. Okay, so we have that every single year for each fund. We can then calculate the average net value added for each fund over the sample period. And once we have this, we can then compare the average NVA across groups of funds. So now we're in a position to estimate how profitable the green urban development strategy has been for the large Canadian pension funds. Now, there's pros and cons to the benchmark method. It has a lot of advantages. It's easy to implement, one. Two, it's consistently applicable to real estate portfolios around the world, which is important as we do this comparative analysis. Three, it relies on benchmarks that are investable and give real-time information about the risks. And four, it provides a reliable way to estimate the net value added for groups of funds. Now, there is a danger of overfitting the data as we look for these combinations of parameters. To mitigate this risk, we do restrict the number of values that the parameters B, G, S, and L can take. We also remove, for some of the outliers, where the benchmarks has some weird properties, we remove the 10% of funds with the lowest correlation between the benchmark and the reported return. For the remaining funds, the correlation is quite high. It's about 93% on average. So the benchmark does a good job at matching the reported returns of the funds. And three, and this is important, we will do extensive analysis in the paper to verify that the inferred parameter values make sense. We will compare those values with some of the surveyed results that CEM has with some survey data on global leaders. We verified that those parameters are quite consistent with what we expect in terms of the leverage ratios, in terms of the geographic mix, in terms of the smoothing parameter, in terms of the lag parameter. The results are actually quite remarkable in terms of picking up parameters that make sense. So that gives us for every fund a benchmark using a common approach. Once we have that, we now have for every fund an average net value added that we can compare. To show you that this actually works quite well, this is an application of the benchmarking method to the NPI index in the US. The NPI you see is in black, in a solid line. And here we have the US REIT index in dotted line. Now the REIT index is much more volatile. It seems to be moved by a few months away relative to the NPI. First, if we impose the parameter B, the bond weight, so we delever the REIT index, we already see that the volatility of the REITs become comparable to that of the NPI. If we then impose the smoothing parameter, we get even closer. And once we impose the lag parameter, now we obtain the correlation between the REIT index, modified, delevered, smoothed, and lagged, with the reported return of the NPI, a correlation of about 94%. So the combination of deleveraging, smoothing, and lagging is giving us a benchmark that is quite comparable to the properties of the NPI. Okay, and we repeat that methodology for every fund. So this is the results on the net value added. We have Canadian funds, rest of the world funds, and each fund will look at all of the funds, the large funds, which again are 50 billion and above of AUM, what we call the direct funds. These are the ones for whom the real estate portfolio, the majority of that is directly managed. And then we have at the bottom the large and direct funds, and that's the category that we're the most interested in, given the parts 1 and parts 2. What's interesting when you're looking at those results is that the net value added is the strongest for that one group of the large Canadian funds that do a lot of direct management. It's large. The average NVA is about 148 basis points. The median is also very high, which confirms that the high average is not driven by outliers. This is the highest NVA. What's interesting when you compare the large Canadian funds with the rest of the world funds, for the most part, the NVA in real estate tends to be negative, about minus 200 bips for the average rest of the world fund. It is highest for those rest of the world funds that have a high fraction of the portfolio that is directly managed. We now have a 45 positive NVA. But that 45 bips, even that is about 100 bips lower than what we observe for the large funds in Canada, which seems to suggest altogether that the strategy in real estate implemented by these funds seems to be quite successful financially. And again, all of that is net of fees. We can also look at the average returns. We calculate the average returns for the fund as the sum of the benchmark returns over the the full period, plus the NVA. What you find for the large Canadian funds is between 2005 and 2019, the average annual return was about 9.7% in real estate. This is high. It's higher than, say, than the average real estate returns for non-Canadian funds, about 4.3%. The difference has to do with two components. One was the strong performance of the real estate market in Canada, but the other one is the strong net value added of these funds. Again, about 1.5% of NVA. All right, so the last question is, why is this strategy successful? What we find is that this is a strategy that is focused on project execution in private real estate. So the Canadian pension funds do not share the ownership with many other investors. As a result, they have full control over the operations. They do not face agency issues that arise when ownership is fragmented. On top of that, the strategy promotes direct communications between owners and managers, low fees because of the elimination of intermediaries, low cost of project financing because ultimately the leverage is done at the total fund level, not at the real estate level. And finally, and I would say perhaps most importantly, the strategy provides the ability to extract the full economic profit from the real estate ventures. In other words, it provides the ability to get the developer's NPV. When I think of the financial markets, competitive financial markets, investors come in, buy the asset at a fair price. The NPV is captured by the entrepreneur, the developer. Here, by combining the developers' function directly as part of the funds are capturing the full NPV from the ventures. Now, of course, when you combine the operational management of the assets together with the investments, you have some risks. You have legal risks, operational risks. There's also liquidity risk related to the long-term nature of the projects. And of course, you have COVID-19 related risks, because the question is, how many people will come back to the workforce in their office in the coming years? What we do find is that the Canadian funds have implemented several risk mitigation strategies. First, the model of impact investing is restricted to a specific set of projects. The projects are well defined. They're all very similar types of towers. They're similar across major cities. The risk profile of these towers match the long-term risk profile of the liabilities of these funds. Second, the projects adapt to multiple economic scenarios. They tend to be mixed use, as we saw early on. Mixed use towers in downtown areas, close to public transportation, in major cities with diversified industries. Third, combined with this strategy, we find there is a global diversification of the real estate portfolio, which helps to diversify some of the risk. There's also increased investments we've noticed over the past few years in network and data centers, which seems to do well during times of the pandemic. And fourth, the use of wholly owned real estate operating subsidiaries provides a number of advantages. One, experience in developing and managing projects. In many ways, experience is a risk mitigant. Two, access to large networks of suppliers and retailers. Three, protection of legal risk because you are a separate entity. Four, additional flexibility regarding compensation since the developers' compensation structures are different from investors. And five, as we discussed before, a reduction of agency issues. And so to conclude, what we find in this study, if we take a step back, we think of most institutional managers outsource their private real estate investments. Again, most non-Canadian funds have about 16% of the portfolio in real estate directly managed. There's fees involved. There's specific short-term contract structures that are involved. There's the question of whether managers potentially overpay for ESG investments. What we do find in this paper is that the direct green urban development seems to be a win-win, in the sense that it does create long-term value for pensioners. Net of cost, we do find additional performance relative to the benchmark, while at the same time contributing to sustainable urban development. And so having a win-win strategy in this space seems like a promising way to think about how to conduct ESG investing for some of these large funds. And so this is it. I very much look forward to the Q&A. Thank you.
Thank you, Sebastien. So for everyone in the audience, please put your questions into the chat box, and I'll endeavour to ask them all to Sebastien. So the first question we have is actually from Sally. Does the green certified buildings generate more returns compared to those with no LEED certification?
It's a good question. We take as a premise in this paper that the green does add value. There is, I was citing it earlier in the presentation, there is evidence that green buildings do provide value for developers. The way we looked at performance here was directly at the portfolio level of the funds. Do the funds that implement the strategy a lot generate additional benefits on their portfolio? The answer seems to be yes.
And I just like a follow-up question on that. When we say green building, where do you see the benefit coming from? Is it necessarily the environmental sustainability side of it, or is it just the fact that they are just better buildings, as in more pleasant to work in, and so people are willing to pay a premium?
I think it's both. You have the environmental sustainability aspect of it, which is important. In fact, for many of the tenants, it's important to show that you are having your headquarters in one of these buildings. From a pure investment perspective, you're able to get higher rents, lower maintenance cost on the buildings, and so you're able to combine both.
Okay.
At least that's what the evidence suggests from the returns of these funds.
Since we're not necessarily getting questions from the audience, I'm just going to keep on going with my question, Sebastien. So I'm interested in how much influence has local knowledge been for these direct investments? As in, we're talking about large pension funds that are based in Canada. Many, like you say, are based in Toronto, and we're talking about the actual buildings being in Toronto. It's easier to harvest money when you're closer and you understand the market so tightly. Do you see a capacity issue for this strategy?
It's a great question. In fact, there is one statistic that I haven't shown in the presentation. When we look at least all the deals that we have collected, most of the deals tend to be done by a local fund. So for example, if I recall, if we look at Ivanhoe Cambridge for CDPQ, the majority of their deals will be in Montreal. I think we had about 75% of the deals that we had collected. If we look at OTPP or OMERS or Hoop Infra, again, the majority of the deals will be based in Toronto. And so there is a local element to it. The local element is important for a number of reasons. One, you get additional expertise being in your local sector. Two, you end up having direct benefits to your own pensioners. Oftentimes, the pensioners are located in the same area. So not only do you contribute to sustainable development in the local area where the pensioners live, but you are able to generate that value added through expertise. What we have seen, and there is potentially a question of capacity constraints in Canada, what we have seen is once you have developed that experience locally, you're in a good, strong position to expand your expertise abroad. And so it's interesting, another statistic that I haven't mentioned in the presentation, when we look back to the Preqin properties, the Canadian funds, the 6-7 largest Canadian funds, do more deals in the US in the direct real estate space than all of the large US funds combined in the US. Right? And we see it with the Texas towers that I showed, or in New York, there is an expertise that goes south of the border and potentially abroad as we continue to grow it.
So Greg is asking the million-dollar question, or almost billion-dollar question. Do you expect the performance statistics to be impacted by the pandemic? And if so, what elements will be impacted?
That is the million-dollar question. It's very hard to put a clear answer onto this because at this stage, it might be one of the greatest risk factors for the central real estate. What I can say is what's interesting is the loss incurred right now on the real estate is partly offset by the wave toward ESG. So what we can potentially expect in the years to come is an increased demand for sustainable buildings to be in for office space by the tenants. And so the value of the LEED certification may actually increase in the years to come. And so this may act as an offset relative to the what COVID is doing. Also going back to the end of what I was discussing in the presentation, there has been increased diversification away from the classic retail space. The Canadians are less involved in retail than the American pension funds would be, but still, it has been a large share in the portfolio that has been the most impacted sector. We do see an increase in data centers, in network centers, in global diversification away. I mean, so in all of these sense, these will act as risk mitigants to what we see right now in the COVID crisis.
Okay. Bob has got a question about whether you see a difference between the Canadian and non-Canadian funds in terms of the balance between greenfield versus brownfield investments.
So we found a distinct involvement in Canadian pension funds in greenfield ventures. For example, another statistic that I haven't mentioned, if we look in Toronto and we look at the 10 towers currently, the 10 tallest towers currently in construction, 3 of those are Canadian pension fund projects. I don't think we see this anywhere else in the world. In fact, if one member in the audience has the name of a city that has had more impact, has received more, has been more impacted by the by pension funds than Toronto, I would actually be interested to learn more, because my sense when I look at the 3D map is that Toronto is unique in the impact of Canadian pension fund involvement relative to other global cities.
So Patrick is asking, do you have a sense of how the other large financial centers such as New York City would compare to Toronto relative to the lead mapping you've done?
We initially started the analysis with all the Preqin properties, which tend to be more based in the US. And we noticed actually that a lot of the New York projects tend to be Canadian pension fund projects. When we decided to do the mapping and we realized that the lead universe was not sufficient, we focused mainly on the Canadian cities, because we noticed that the greenfield ventures and that type of green urban development strategy is mostly concentrated at home locally. We haven't done the mapping for New York, but I would suspect that a substantial number of buildings in New York, based on what we see, have been owned and greened by the Canadian pension funds. In fact, it would be interesting to see there as well.
Okay. So stretching a little bit broader a topic, as in Sally's asking, given the long-term low rate environment we're expecting,
Yes.
do you see real estate as a replacement or where some of the fixed income market is actually moving to?
I do. In fact, this relates to the earlier paper on the quantitative portrait of the Canadian model. When we're looking at the Canadian model strategy, we look at it a little bit as a LDI 2.0. We see a model that is able to generate returns while continuing to hedge against liabilities. And what's especially important about Canadian liabilities is that they tend to be more indexed than some of their global peers, indexed to inflation. But the result means, because you have that indexed nature of the liabilities, the result is that many of the assets that do have an implicit inflation hedge, such as local real estate, can be good not only because of a portfolio diversifier, but on top of that, they do provide a hedge against liabilities. And so what that means, as we're moving now to an environment where rates are going down or have been low for a while, how do we get those extra returns while continuing to do a decent job at hedging the liabilities? In many ways, real estate is such an asset class, which explains partly why the Canadian funds invest twice as much in real assets than some of their peers. Here's an asset class that has some good long-term hedging properties, especially for the building close to home. And this is an asset class where the Canadian funds can generate the net value added through the development activities. Now, it is a sensitive topic to start thinking about how the investors can start merging the development function directly as part of the investment fund, because there's a reason why investors are investors and developers are developers. But what we see is that in the context of real estate, you have projects that are well-defined. You have projects that fit with the risk profile of the liabilities. And so it is a project where if you were to go and venture in order to get the alpha directly from the source, this would be one of the businesses that is feasible. And so in that sense, going into real estate allows to extract the value added, extract the alpha, while holding on to an asset class that has similar properties to bonds.
Yeah. So, picking a little bit more on the Toronto market in particular, is in you say, you can look in the skyline. There is construction going on everywhere. Very large towers. The CIBC towers have just been put up. The new TD tower it's on its way. It's a big hole at the moment. You can name that with a couple of other towers in that central area.
Yeah.
Couple that with the whiplash effect that we're seeing on commodities, with the multiple increase in steel and lumber prices, and basically the raw materials that's required for these large structures. Is there potential for a crunch?
It's a good question. The answer is I don't know. I don't have a good answer for you on this. It's the supply crunch that we observe have been quite pronounced over the past few months. In many ways, it may be a temporary crunch as the world is getting back to speed from the COVID pandemic.
Yeah, I suspect it's a whiplash effect, but it's just echoed across the world right now, and who knows how long it's going to last.
Yeah.
Okay. Sally's asked, so besides real estate investments, Canadian pension funds will also invest heavily in infrastructure projects, particularly international infrastructure. What's your opinion in relation to specific risks in investing in infrastructure and also in emerging market countries? So kind of two questions in that sense.
So what's interesting about infrastructure is that it has similar properties to real estate in the long-term cash flow profiles of the projects. Oftentimes, those projects in infrastructure can be bigger than real estate. I mean, real estate, you have well-defined towers you can replicate in multiple areas. Infrastructure is a broader reach. I found fascinating when you see what the La Caisse is doing in Montreal by building that train from the downtown to the airport. Building it again from the ground up. So this is one example of a large greenfield project. In a way, it is venturing away from the real estate and doing more. I suspect that similar to real estate, these are types of projects that are done locally at first in order to build that expertise. Building a big train system is a big venture. You often see it with the bigger funds because they do have expertise with multiple suppliers engaged. As that expertise builds, there is an opportunity to extend it to emerging markets, going back to your second question. But again, as we are talking about investors taking on the role of developers as well and combining the two functions, it has to be done in a way where you have a good sense of how to mitigate the risk and control the operations. And so to me, these ventures make a lot of sense once you know how to do them well at home. And then you can start expanding it exactly the way that we have seen the funds doing on the real estate front.
So I'm going to extend on that, and it was a conversation we had earlier when we were doing the prep meeting for this. As in, you echoed to me some statistics about just how much of the cream is taken out once you externalize. And so you were saying something like almost all of the cream is wiped out. By doing the direct investments, you're picking up an extra 140 bips or something like that, if I recall our conversation correctly. And yet, if you externalize that, you basically wipe out 138 of it. Or I may be a little bit wrong with the numbers. Can you talk to the audience a bit more about that? Because that was quite an impressive stat of just how much extra yield it is by taking on the operational risk.
There is a contemporaneous paper at the moment looking at infrastructure projects and funds investing in infrastructure through external intermediaries, and finding that generally speaking, funds going through external vehicles underperform relative to the benchmark. We do also find that in real estate, when you're looking at, especially at the non-Canadian funds, a net performance, a net value added of minus 200 bips, which is large, right? It's minus 2% relative to what you could get simply by investing in REITs. When you look at the difference between the positive net value added of portfolios that are internally managed versus the net value added on the negative side for portfolios that are externally managed, the total difference is close to 2 to 3%, which is interesting because that actually is consistent sometimes with oftentimes the size of the fees that are incurred. And so that raises a question: why is it that there's such a revenue differential between the internal and the external investments? And part of it, I suspect, is that well, one, they are cost savings naturally obtained by internalizing the portfolio. You do not need to advertise to external clients all the time. You now have an exclusive client supplying capital. You have lower cost of project financing. You can more easily take on ventures and so forth. But also, a lot of the NPV is now captured directly by the funds, right? So if you have a lot of competitive markets, you might have that the bulk of the NPVs is extracted by the intermediaries themselves. Whereas by internalizing, you are actually capturing the NPV locally, and the NPV can be big. And so we think that this is explaining quite a bit of the differential.
And that's quite a large size capture by the intermediaries, isn't it? Do you feel that they've got a negotiation advantage and opacity on the way that you can get the liquidity in the market, that they're able to capture that much of the cream?
I mean, the numbers speak for themselves. On average, the NVA tends to be negative. For the Canadian funds that do not internalize a lot of their investments, the NVA is close to zero. So when we're looking at the Canadian funds, we have the very large one that manage internally a lot of their assets. We have those that are less large, still I would say above 10 billion and above, but that manage more than 50% of the real estate portfolio internally. And then we have all the other ones. When you're looking at the residual NVA for all the other ones, the net value added, you get numbers close to zero. In the case of many of the non-Canadian funds, what we suspect is going on is the sample is dominated by many American funds that suffered large losses during the 2008 financial crisis because of high leverage, and then closed the strategy or switched to a new strategy right after the crisis. And so in many ways crystallized the losses. And that in turn feeds to a negative NVA when we're looking at the full sample. So we suspect that this is contributing to the very low negative NVA that we observe for the non-Canadian funds. But we did find in the first paper on the Canadian model, we did find significant differences in not just the alpha relative to the benchmark, but also the total level of portfolio efficiency of those funds that internalize many of their resources. And this is not just because of the NPV that they capture. This is also because those cost savings associated with going internal gets redeployed inside the firms, make up for stronger risk management units, more resources spent on IT, and also a better choice of external managers because you have a team locally that is better equipped to make those decisions.
Yeah, so that scale is important. I take it then.
Yes.
Yeah, as in, your smaller fund. Dare I say, it's a small building, 8 to 10 stories tall. It's still going to cost 140 million or thereabouts. Yet, when we're starting to talk office towers, such as like the TD Tower, we're talking close to the $1 billion. You're not looking at a small fund then.
You're right. We did ask ourselves the question, and I don't have a good answer to that. Why is it that smaller funds are not doing mini ventures of this? right? At the condo level, as opposed to doing a grand tower in the downtown. So that remains to be answered. But going back to your question about scale, what we did find in the first paper on the Canadian model was that scale definitely helps you to go in those private asset classes and internalize. But even smaller funds, smaller than 10 billion, were able to achieve some of the internalization gains without going all the way as the large funds. So we call that the Canadian model light. What we found was what smaller funds could internalize more on the stock markets, on the bond markets, where it's easier to build an internal team. And already that was helping to generate some gains. Externalizing still many of the investments to the private assets, but already having more of a team internally to help make those decisions.
Okay, so we're almost at the top of the hour, so I might pass it on to you, Sebastien, for any final thoughts you want to leave to the audience.
What I found particularly striking doing this research was the fact that you can be green while generating strong returns at the same time. What we find with this green urban development strategy is that there's an alignment of the ESG with the long-term returns. It does require restructuring of the development function, internalizing it, bringing it in, but that is promising to think about, because it sets to align incentives, encouraging funds to do both at the same time without having a negative impact on the other. So I think the more we can look for these win-wins types of strategies, the more we can have a positive environmental effect while contributing to the long-term value of our pension plans.
Okay, that's fantastic. So this has been a great session, Sebastien. Looking forward to seeing what your next research project's going to be and what we can present here to our GRI members. To all the attendees, thank you for your participation today. And once again, thank you, Professor Betermier, for a great session today.
Well, thank you, Bruce, and thank you all for taking the time to come and listen.